Welcome to International Securities Exchange's podcast series. Facilitated by renowned educators, ISE podcasts are intended to teach beginning as well as seasoned investors the ins and outs of trading. To find an updated list of podcasts, please visit www.ise.com/podcasts. Please be sure to listen to our important message following this episode regarding the risks of investing in exchange-traded options.
Let's look here. This is, again, the natural gas ETF that you'll find on ISE. And here's a really good example of a three-wave trend. Now, on this one, we have this initial push off of highs on the 16th, and then the correction. Now, notice this correction takes 6 bars to the upside. We're looking at a 15-minute chart here, and we've got 6 bars on the upside. So basically an hour and a half here. We have a continuation move on the downside. Now, typically this would have held right here, but we were going overnight, so that kind of changed the dynamics just a little bit. We had a gap down, but you'll notice that this is, again, 5 to 6 bars on the upside before this turns lower once again. So same amount of time here. I'll clear this so you can see it a little bit earlier. We have 1, 2, 3, 4, 5 bars on the upside here. 1, 2, 3, 4, 5 bars on the upside here, with the trigger breaking on the 6th bar in both cases. So A and B, the corrections are lasting the same amount of time. And this is really key here. And you can see a little bit of a difference over here where we had an uptrend move, a correction of 3 bars, uptrend move, correction longer, uptrend move, another correction about 3 bars, and another continuation on the upside. So we have these series of higher highs and higher lows, but we have more than 3 waves because there's this longer correction in the middle here. And so that kind of shifts the dynamics of that trend development. Now, following this third wave of movement to the downside, we also have a little bit of a volume increase here, which is one of the signals for trend exhaustion. And we have a little bit of a shift in momentum where you can see that there was this large flush here at number 2, whereas the momentum actually shifted and slowed down here at the end of 3. You can see that with these tails. And if you drop down to a 5-minute time frame, you would see that shift in momentum even better, where it would look like this, basically, heading into that third low. We looked at this on a 5-minute chart. And it would actually have those 3 lows, which would show the trend exhaustion even within this third push to the downside. So you have not only the trend exhaustion forming on the 15-minute charts, but you should also have it forming on the 5-minute chart as well. And so that leads to a change in the larger trend. And because the momentum was still on the average side here, though, pushing into that third low, you can see it formed more of a V type of setup coming off of that low, which when it came into this previous high, led to a resistance level. So it fell into this area of congestion, and that's because we have more of this V type of action. So the high over here serves as a stronger resistance level. Now, the support and resistance levels I've touched on very, very quickly, but these are the third thing that I look at, the third building block, basically. And these are price levels in the market where a security is liable to react in some manner that's going to affect the trend that's in play as those support or resistance levels hit. Now, let's look at how momentum factors into support and resistance levels. Let's say this is a support zone. So a support zone in security would be something where we would expect a reaction coming off of falling prices. But the momentum of that decline is going to depend, or basically how well it holds that support level is going to depend upon what the momentum of that decline into that support level is. So if we have a more rapid descent, a stronger than average move, it can push through that support level or kind of like have a more give to it before it reacts to it. And so oftentimes you'll see a slower reaction and you can see more give to the downside. Where this becomes important is that when you're setting targets on a trade, if you have really strong follow-through and the momentum is increasing, you might have a target level at a support zone. But because it is falling so quickly, you can actually get a little bit more out of your position than you would if you had a more gradual move into that support or that target level. So when I have something coming into a support level that I'm looking for as a target on a short, then my initial place to look to take gains is going to be slightly above that support level like we saw over here, because I'll know that a support level is a zone, and sometimes it doesn't hit an exact price. But if I want to have like the best guarantee of a fill, I'm going to fill it as it's going into that zone. But if on the other hand, the momentum is really strong as it comes into that support zone, then I'm going to wait, and I'm going to look to get a little bit more out of it and see how much more it can flush through that zone. It's also really important in terms of stop levels, because if you have something coming into a stop zone, if it hits it very hard, it can have more give to it before it bounces up, and then it can turn back around and still go in the way that you were looking at it in the first place. But you have to view that as having a zone of support. So when you're setting your stops, it's never a good idea to say, let's say my stop is under $100 on something. Then it's never a good idea to just give it a couple of cents in most cases. You want to look and see, if this kind of gives a harder flush, how much give is it going to have? You don't want to be one of those first people to just get flushed out and then see prices reverse on you really, really quickly. And the momentum, how it comes into those support zones, is going to determine how much push it can have through it. And you can kind of get a little bit of a judgment when you look back at the past. And you might even say, you know what, this is falling hard. I have a stop level. I can see that it's going to be able to push through that stop level. You might not even want to be willing to take that full stop. If you can see that the momentum has shifted and your strategy is no longer really as valid as you thought it was to begin with, then this can be a good opportunity to go ahead and just minimize your gains or minimize your losses before you have that larger stop level hit. There's a lot of different types of support and resistance. We've got previous highs, previous lows, whole numbers, previous zones of congestion, gap levels where you have like a closure of a gap, equal move or measured levels, and I'll show you an example of that here in a minute. And we also have the indicator support and resistance, so things like moving averages, stochastics, Bollinger Bands, MACD, all of those types of things are going to be different types of indicators that you can use. And here's, again, a very recent example that we've seen with the natural gas ETF. And this is the same chart that we used earlier when we were looking at the momentum or pace shifts. And what you can see is that a previous high, when it's retested, particularly on something where it's a V low or the momentum is a bit slower than a V, is going to serve as a really strong resistance level. Now, oftentimes, if this is slower, coming back up into a previous high, it's not going to quite hit that previous high. This is a little bit odd that it actually did an exact retest of that prior high. Usually it'll fall just a little bit short because we do have overall momentum that is slower than this downside move, but it was helped out to some degree because the momentum did build as it was coming off of that low. So it kind of rounded up and hit that previous high. Now, previous lows can also be a good area of support, such as over here. And you'll see that the momentum shifted, and we had a stronger drop into it here coming into June than we saw back in here with a more gradual pullback. So you can see it has this tail that it kind of flushed through that. But when we look at it here, and we actually draw a straight across line, you'll see that it falls into a trading range right along that previous low. Here's another example. We've got the moving averages I use simple moving averages for the shorter times, such as the 10, the 20, the 50, and even oftentimes the 100, and then I'll switch to an EMA for the 200. I just find that these seem to work the best. For those of you that have questions regarding having a recording of this, it will be made available later. So if you do have to take off, then don't worry, you'll have a chance to review it at a later time. So there will be a recording made available for the session. Here, going back, we have another level, which is the congestion zone here. Basically, we've got a lot of overlap in prices. And this congestion zone actually goes back in here as well. And so this entire level here becomes a support zone. And you can see that that ended up holding here as well. And when you have a couple of different types of support or resistance all hitting at the same time, it's going to be a stronger level of support or resistance. So for example, here we've got the 100 SMA, and we have a previous high, and all of this congestion. So this zone becomes a really strong support level for this FCG that we are looking at. Now over here, for example, we have a previous high, and we've also got this 50-day moving average as resistance. And we probably got some Fibonacci resistance in here as well from around 62-ish Fibonacci retracement zone. So we're looking at a couple of different types of resistance there as well. So the more you have coming together, the stronger that level is going to be. Now let's go and look at how this actually plays out in terms of strategies. We've got about half of our session left, and I want to focus on how we can put these together to develop a really strong strategy for trading these ETFs. And what you're going to find is that the ETFs, one of my favorite patterns is one that I developed that I call a momentum reversal. And we're going to look at the basics for just kind of a core understanding of this pattern. And what we're looking at are each of those three building blocks of price development are really going to come into play here, particularly the first two. Obviously, given that the term that I use is momentum reversal, momentum is a big deal in terms of this one. So what we want to see, first of all, is going to be a stronger push to the upside or the downside. This can also be used as a reversal off of lows. And then we want to see a momentum shift. And again, we're looking to transect this shift in buying. So we have a series of higher highs and higher lows, but we've seen an overall shift in momentum so that when we transect this channel, we have a change in the momentum of the channel. And for me, I want to see at least the 3 highs form and 2 lows. This is where the trends development comes into play. Now, not only are we now looking at an exhausted trend here because we have 3 waves of upside, but if this takes place following 3 larger moves of upside, oftentimes that will happen. This will take place within the 3rd leg of upside in a larger trend. Then you've got an even stronger pattern that's developed where you can see a larger trend reversal that just sort of keeps going. Now the next thing we want is basically how to enter this strategy. And the simplest way to do it is to connect the 2 lows and take this as a channel break. Now what can happen is that you might see a little bit of a pause here as that channel breaks, and so that can give you a chance to kind of get in on it on a little bit of a tiny bounce at the lower end of that channel. An even better way of doing it is when the channel heading into that 3rd high breaks, and sometimes you'll have a little momentum reversal at that high too. And that channel break is the most ideal location to get it, but if you're looking at intraday charts, sometimes that can be a little bit difficult to get because it can go really, really quickly, especially on like a 5-minute time frame. So If you miss that, though, you can always look for these continuation moves. And another one is you'll see a shift in momentum. Sometimes this will be two waves here. So you can get in on the continuation here as well if you missed one of these other places to try to take it. Let's look at some examples here. Here's an example from a few months back. We were looking, I gave a class here earlier in the year where we talked about this strategy as well. And we were looking at the FCG again. And there were a number of examples that took place at that time. So we had a strong downside move. Here's the three lows. If we look at connecting the highs and the lows, you can see that transecting it shows us a change in that momentum going into February of 2009. And taking a break in this channel was the ideal buy trigger, but overall this momentum was still pretty strong on the downside compared to this previous move. So that increased the risk a little bit. Here's secondary trigger here when that channel broke to the upside heading into April. And we actually had this followed back on back with a couple of more of these types of momentum reversals. Here's a two-leg up, which is common. And then we had the three highs. Again, transecting that. And the channel break here, leading to a really great start of what could have ended up being a stronger move on the downside. Now, taking that channel break into that third high is obviously the most ideal entry right here. And the reason this can be the most ideal is obviously if something changes in how this follows through. For example, if this is a really extended trend on the downside going clear back, a lot of times we might be dealing with a rounding off at lows on a larger time frame where the larger time frame trend development is not favorable for continued downside. And what you want to see is you want to see a strong initial move on the follow-through. But if you have something where then the momentum starts to shift again, such as here where we had three more lows that were each slightly lower than the last, this shows us, wow, we have another small momentum reversal forming, this time compared to this drop. And so if you were in this as a short initially, this would be a strong heads up that, you know what, hey, when this channel breaks, that's going to not only trigger my need to get out, but it could even trigger a reversal where you can change positions, swap sides, and end up going back in again. And if you take it coming off this third high, you can see what a difference that would have made, because if you took the channel break instead, basically your adjusted stop or your reversal entry are going to be fairly comparable in this example. That's not always going to be the case, obviously, but you can see how it can really change what you're looking at in terms of the reward potential on a position. Let's look at a couple more examples here. Here we're looking at this again. And we're seeing a series once again. Here's the stronger downside. Three lows, each slightly lower than the last. Transected trend. Channel break right here gives us that initial buy trigger. Now, if we had tried to do a channel break on this, we'd actually be looking at it as not actually breaking because we have a little bit slightly higher highs. So we have kind of this widening pattern instead that is formed. And this is actually a higher risk type of strategy than if we have more of these parallel patterns forming with each of those three lows. This breaks, and then you can see the momentum once again starting to shift. So that tells us that you get in here, you're going to want to go ahead and just take all of your gains coming off of that third high, because the chances are that you're going to see that reversal, and very good odds that it's going to end up breaking through what your original stop would have been as well. Here's another example. Three lows. We have a little bit of congestion for that first low. Second low, third lows. Channel break here gives us that initial trigger. Secondary trigger would have been over here, which is quite interesting because it's also looking at it as if we were looking at that earlier pattern when I talked about momentum and pace. Let me go back and pull that up here. I'm going to just show you that very quickly because it's a really good indication. There was just that slight downside move with the 3 lows. So we had the 1, 2, 3 coming off of this larger downtrend, but as it came into that upper channel, it hugged it. So we saw the momentum actually shifting compared to here. Let's go back again and look at that here. And it really impacts the success of this strategy because you can see that by having the shift in momentum now, where you had the V and then a slower pullback here, look at how fast that broke coming out of this channel. So it was a really strong continuation type of move. It gave a secondary entry for this momentum reversal as well as a strong confirmation of that move. And notice the volume was also dropping as it based or hugged that upper resistance level. So we have all of these building blocks of price development working together here where we have that stronger reversal on the upside where it breaks really strongly with this sharp move here back in March heading into April. Now we had another example really just a couple of days ago where we had the same type of thing. We actually had a couple of them where there was a momentum shift. We're looking at a 15-minute chart. Again, we're looking at the natural gas here. I prefer to trade this one. It really has very, very smooth moves, and it holds technical analysis cues extremely well. It's a really great ETF for trading. And you can see here again, strong upside. Here's the beginning of the shift. This is a little bit of a variation on the momentum reversal. Here's our initial 3 highs. But then we saw momentum shift within this channel here before it broke and triggered. So it ended up hugging the lower end of that channel here with number 1 before we had that stronger continuation of the breakdown. And then we had a similar change in momentum here. Again, a little bit of a variation because we had a slightly similar second low and then a slightly lower third low. The thing that you need to keep in mind when you're looking at strategies is that a lot of them aren't going to be textbook. You need to recognize the gist behind the strategies, and that's going to be these 5 building blocks that we've gone into. Well, we've gone into the 3 so far, but that's what is the most important in terms of how to look at these. If you get too locked into a lot of the strategies per se, you end up missing a lot of things because you don't realize, well, this one really still fits into the same category as the other ones. It's the same type of strategy with just a very slight difference to it. Sometimes those differences make a huge deal, and sometimes the differences really don't impact the type of strategy in the least. And the more familiar you become with using these techniques and the longer you trade, the more you're going to start to pick out, which one of those differences is really important and which ones are going to make least impact on the success of the strategy.
Thank you for listening to our podcast. To find more podcasts on options, stocks, alternative markets, and market data, please visit www.ise.com/podcasts.